The liability section, and we talk about liabilities in more depth tomorrow, but the liability section needs to be in place at the time of signing of contracts. There will be an element of backdating, and underwriters are prepared to accept that as long as the contract has been signed and is in place before the loss occurs. What doesn't work very well with underwriters, if you go along with a contract and try and backdate cover after the loss has occurred, that doesn't usually meet with a very warm reception. When does the policy stop? There are some policies that have what we'd refer to as a sunset clause, so not beyond date, irrespective of whether the project's finished or not. That's not our preference. At the moment, regrettably from your point of view, the market is quite soft at the moment, so the buyers are able to get what they need, and so you in today's market you wouldn't see that type of thing. Any construction policy at the moment would be right the way through to handover. And by handover, that in itself is another issue, a complication. What do we mean by handover? The contracts will usually require that the principal will take over the property. It will become their asset at the point of a formal acceptance certificate. If you've got a clean acceptance certificate and the contractor comes along and he says, there you go, Mr. Oil Company, your project is built, my job is done, there's my final bill, you can now start operating. That's very simple. But it doesn't happen that way very often. Usually what happens, there'll be a handover, and there will be a number of items, punch list items, that remain outstanding. Sometimes very small, sometimes more significant. What needs to happen is the risk management department needs to be working closely with their broker to make sure at this stage the underwriters are aware what it is they're covering, and it's our job as the broker to make sure that the right policies are in place, because at this stage you would have an element of an operating policy and still an ongoing construction policy. The point we make here, a construction policy is very, very appropriate for building. It's not appropriate as an operating policy. So at that point where you get an overlap, it's important that both the operating insurers and the construction underwriters know what they're on risk for. And the market will respond to that, but it needs to understand what it is it's covering. And that will be done between the broker and the risk management department understanding where they are at the particular stage of handover.
Quite often a principal contractor would like to say, well, we're going to go from when we have final acceptance. The trouble with final acceptance is it often includes the period of the warranty period for some of the underwriters. So it can go on a lot longer than what the actual underwriting would like, which is effectively the introduction of hybrid carbons and actually the completion of testing and commission. So it's an area that really needs to be looked at. It's a huge debate, actually.
So what is the issue of the handover? As Jeff just said, formally it becomes the principal's project at that point, the contractor is finished, but it becomes the trigger point for the maintenance and the discovery periods to commence. And that's a limited form of cover. It's your guarantee period, if you like. So the project has been handed over, it's early stages, going through the testing and commissioning stage. There might be some small issues that weren't visible until start-up operations, and if it can be proved that they are construction-related activities, they will be covered during the discovery period and the maintenance. Years ago, the modern market form, there is a sort of fairly standard construction form in the market now. When we all started many, many years ago, the construction market was much broader than it is today, and as a result lost a fortune, and as a result the market has now got a much tighter form. But it wasn't uncommon for maintenance periods to be 24 or 36 months and discovery periods to be the same, but they didn't run concurrently. So your maintenance period would run and then your discovery period would run after that. So if you had a 3-year construction policy with 24 months maintenance and 24 months discovery, you'd have your 3 years plus 24 plus 24. So the underwriters were on risk for a very, very long time. Now it tends to be 12 or 18 months, as Jeff said. They run together, the maintenance and discovery period, and once that 12 or 18 months is up, the policy's finished. That becomes the sunset clause. There's no more claims that can be made on the policy. So it is critical that the handover is made known to the risk management department so that they can advise the underwriters. And in practical terms, that can be a problem because handover is a critical stage of the operation. There's lots going on. The project, it's often at a very high risk for the project. The engineers and the teams working with them are focused on the project, and invariably insurance isn't something that they're thinking about. So and an engineer will always tell you nothing can go wrong. They will always tell you their project, you don't need insurance on this project. When Jeff and I were at Heath, we were responsible for insuring the Troll project in the North Sea. And that was the biggest man-made structure that was ever towed across the surface of the world. And it was constructed by Shell. And at the time that they were doing the construction project, there were challenges that they hadn't yet come up with the engineering solution to. But and the underwriters charged a fortune. There was a big loss in the North Sea just before the Troll project was insured, called Sleipner. Sleipner involved a faulty part. Was it a faulty weld on Sleipner? Wasn't it? It was a fatigue on a bracket, wasn't it? But it was a faulty issue, and during the tow out, the jacket dropped to the seabed. So the market were very conscious of large losses in the construction market, and yet the Shell engineers for the Troll project would say, "Oh, this can't go wrong. You don't need insurance; it can't go wrong." But they actually didn't know what the engineering solutions were. So how they could say it can't go wrong when they hadn't yet come up with the solutions, I don't know. But that was a construction that took 5 years, and at day one, they actually hadn't come up with the solutions as to how the issues would be resolved because of the water depth. And as Paul mentioned earlier, I always grew up thinking the seabed was flat, but when you look at some of the pictures of the North Sea, there's mountains under there, and they had to get across some of these sort of mountain ranges with pipelines and things like that. So what are the contractual considerations? Going back to the very early slide where we had the circle around the group, that everyone has a role to play, and the idea of the construction insurance is to wrap around that family, it's to wrap around those obligations. There are standard contracts around the world, certain parts of the world where there's been lots and lots of activity, UK sector of the North Sea, Norwegian sector, Malaysia, where there has been lots and lots of activity for the last 30, 40 years. There are standard contracts, and those contracts, the oil companies know what they're responsible for, and the contractors know what they're responsible for. Again, one of the challenges in our industry, they are like families. Oil companies need contractors and contractors need oil companies, but they do like to fight, and they do like to pass obligations on to each other. So when the oil price was very high, the contractors had the upper hand. So when it was negotiating contracts, the oil companies were to an extent beholden to the contractors. The contractors had the equipment, the contractors could demand day rates that were extortionate in the view of the oil companies. Not necessarily the day rates that were the issue, they would be demanding certain clauses to go in the policy that were very favourable to the contractors. Well, the oil companies have obviously got long memories. So now the oil price has come down. What we're seeing lots of are contracts that the oil companies have entered into with drilling contractors for, say, a 3 or 4 year period. They're now turning up to the drilling contractor and say, do you know what? That contract where I'm paying you $500,000 a day for your unit, I'm going to cancel that. And the contractor will say, you can't do that. There's a cancellation clause and it's going to cost you 3 million, 10 million, 50 million to get out. And the oil company will say, that's fine, we'll pay you that because I can come back to you tomorrow and I can rehire that equipment for $100,000 a day. And so there's always tit for tat. Soft oil price, the oil companies at the moment, none of them are making the money that they want to, they're not making the margins, but they will certainly put the squeeze on the contractors and the drilling contractors and the seismic contractors. And I'm sure you've seen in the press that a lot of the contracting firms are laying off staff as a result of the fact the oil companies are either not using the equipment, or if they are using that equipment, it's on a much, much lower day rate. We heard of a case recently, a US drilling contractor ordered 3 years ago a brand new drilling unit, huge great unit, that they paid, I think it was $950 million for. It's just come out the yard, brand spanking new, not a scratch on the paint. It's never been used, and it's up for sale for about 300 million. So if you need a drilling unit and you've got 300 million to spare, there's a good one floating around in America. But that is the vagaries of the oil industry, you know, that fortunes can be made and fortunes can be lost. We mentioned earlier on about the projects, where the project is located and where the various elements of the project could be taking place. And that will include the tows and the transits, procurement. I think what I'll do is, this is a project that we insured in Turkmenistan. So here, the project, so this was for a Malaysian client. So you've got a Malaysian oil company with an asset in Turkmenistan. As far as the construction policy is concerned, the steel for that project came from Japan. There was pipeline that came from the States. The hull itself was built in Singapore, actually in the Fells yard that Paul mentioned in his presentation this morning. Fabrication of modules was carried out in the UK. Subsea equipment came from Germany and France, and the jacket was fabricated locally. So here we've got the Caspian Sea. It's called a sea, but it's practically landlocked, not easy to get there, challenging. And you've got all this equipment coming from all over the world, and so the construction insurance has to make sure that all of that is covered. So the policy may, in this instance, may be subject to Turkmenistan law and jurisdiction, but from procurement point of view and from a cargo and transits point of view, it has to be on a worldwide basis. So the broker, when he's assembling the information, there's lots of information that we need, there's lots of detail, and we will spend a lot of time with the oil company risk management department assembling the information that we can then present to you guys to enable you to understand the project and then hopefully charge the right premium.
Most of the transits came down the Volga Canal, which is 2,000 plus kilometers or whatever. Tried to bring it in from Iran, but we had problems with our insurers on that one for fairly obvious reasons. But it was quite an interesting exercise. The logistics was mind-blowing.
Yeah, because it came down here, didn't it?
Yeah, it came down the canal.
Yeah.
And it had to be taken apart into pieces because you can't get that large of items down that. So it was interesting.
So, and again, each construction project is unique to itself, and there are issues that the underwriters need to be taken into account in terms of accessibility. And with something like that Turkmenistan project, an element that you need to take into account is, depending on whether BI is, in that particular instance, there was no delay in startup or anything like that, there was no financial insurances taken out. But if they do, how quickly can something be replaced and got to that site? Because it's one thing if you're trying to get something to Malaysia or Singapore, but if you're trying to get to Turkmenistan, there's increased delays just getting the equipment there. So that would be a significant issue if the policy had been covering delay in startup or advanced loss of profits. So what are the operations that you need to consider? First of all, we talked earlier on about the pipe, the different ways of laying the pipe, the coating of the pipe, the welding. There have been some horrendous losses in the insurance market all around pipe. Usually the problems do not manifest themselves until it's in situ. If they do discover problems when it's on land, usually that can be rectified relatively cheaply. Construction policies have big deductibles. So if it's something that's discovered on land, it ends up usually being a project cost. Once it's offshore, there's huge increase in cost due to the mobilisation and the demobilisation of the specialist equipment that you need. Paul this morning mentioned cranes and had some pictures of different types of cranes. Again, that has to be taken into account. How heavy are the lifts? How much suitable equipment is there? Who's carrying out the work? And again, whether it is an owner-controlled program or a contractor-controlled program, from an underwriting point of view, who is doing the work is critical, and what experience have they got? How much previous experience have they got? And not just building offshore projects, but perhaps in the parts of the world that that the project's going into, because each territory has its own challenges. Loadouts, what type of loadout is it? The size of the equipment, whereabouts the loadout is taking place. Is it in an area that has exposure to acts of God in terms of winter storms, potential tsunamis? Is it in a benign area? Are there quite narrow windows for operations to take place in? And again, with sail away and transit to the offshore site, a project that Jeff and I were involved with again in Turkmenistan. The project, the timetable was all set. There's really only one time of the year that you want to avoid doing sail-aways in the Caspian because of the potential for bad weather, which is January. The project was meant to have its sail away in August during the summer. That's fine. Allegedly, the weather was like a mill pond. It was perfect for the operations, but unfortunately, there had been project overruns. And the overruns went on and on. We were there in September, and they said, oh, don't worry, it's going to take place in the next couple of weeks. So we thought, well, that's okay. September's not too bad. September came and went. November came and went. December came and went. And then it got to the point where the sail away was taking place in the very worst month. So we were talking to the underwriters who'd all along said, well, as long as this doesn't take place in January, we don't mind. So Jeff had the enjoyable task of going to the underwriters and saying, you know you didn't want it to take place in January, guess when it's going to take place? So one of the areas, and we talked about warranty surveyors, we talked about engineering, and where the market does work together. I mean, the insurance is wrapping around the project. You can't stop it. The project needs to carry on. So our view is you've got to you can't pretend it's not going to happen. So Cliff was involved from an engineering point of view. The leading underwriters had their engineers. So we were sitting down every week with the warranty surveyor saying what's happening. For 1 week, it was every day. We'd have conference calls with warranty surveyors in Singapore and in Turkmenistan to actually say what's happening today, what's going to happen, how's it going to be done. So we'd go home and sleep happily, but the underwriters weren't. So some of them had a few sleepless nights. The tow involved an installation that was valued at nearly $1 billion that for 2 weeks was just floating around in the Caspian. I mean, it's not designed to be towed around behind a barge, but they were waiting for the right weather window. They needed a 3-day window. They kept seeing 2-day windows, so they didn't have enough time. So this jacket that was being towed around, that's meant to be sitting on the seabed, was just being towed around and around, just waiting for the opportunity for the installation to take place. Thankfully, the opportunity came along and it all went ahead. But there was certainly some sleepless nights for the underwriters for a few days. And it listed. And they had to evacuate. Yeah. The issues to be taken into account from an underwriting point of view, heavy lifts. Again, it's not just the equipment, but the personnel. Have they got the experience to conduct those heavy lifts? The welding, the size of the pipeline, how many crossings there are, because every time there's a crossing, there is the potential to cause damage. You've got third-party exposures. Pipelines, when they're laid on the seabed, will often have mattresses or rocks put across the top of them. How's that being done? Who's doing that? Is again a consideration that needs to be taken into account. And then the hookup testing and commissioning phase is another factor that has to be taken into account. So if we've looked at the exposures under a construction policy, the next thing to look at is who can be covered. Well, we start with the principal assured, and the principal assured will be the oil company. And as I said earlier, it's very unusual, unless it's a relatively small project, it's unusual for one oil company to take 100% of the risk. They'll have partners. So you might have 4 oil companies taking 25% each. The major oil companies will usually fund it off of their balance sheet, but if you've got some medium-sized and smaller oil companies in there, they may be going to the banks. The banks will always insist on being named as a principal assured. The banks are very risk averse and they rely on insurance. So they will be the principal assureds. Other assureds will be the family that we talked about earlier on, the contractors, the subcontractors, project managers, designers, suppliers, consultants, this group here. And there's an asterisk next to the other assureds. What's the difference between a principal and an other assured? The principal difference is that the principal owns the policy. He is in control of the policy, and it will be the principal that will give the contractors access to the policy. And that in itself can sometimes cause issues if the contractor has risk management department that can be quite aggressive risk managers. They'll bitch and they'll moan about the policy, that it's not good enough, that it's not wide enough, the deductibles are too high. So the contractors and oil companies, even after the policy's been put in place, they will still be niggling each other. But with a with a principal control policy, the principal assured will control who has access to the policy, and any claims that are paid will be routed through the principal. So that's who is covered, and then what is it that we're covering? And this again is where the broker needs to be working very closely with the project management people to give you as underwriters the right level of information for you to understand what you're covering. We talk here all items to form part of the completed works which are included within the declared ECV. What do we mean by ECV? ECV is the estimated contract value. And the way a construction policy works, the principals, the oil companies will come to us with the information. They will tell us what the values are. We'll go into a bit more detail in that in a moment. You as underwriters will charge a premium which is effectively a deposit premium based upon the ECV, the estimated contract value. And that will have a rate associated with that. And then when the project is completed, the principal will come to us with a final contract value, the FCV, and then there will be a premium adjustment based on the FCV. And again, depending on the state of the market, depending on how the policy is put together at the time, sometimes the ECV is a minimum and deposit, and so therefore if the FCV goes down, there could be a refund, a rebate to the assured, or if it's just if it's a deposit, there could be a refund. If it's a minimum and deposit, it can only go one way, which means the estimated contract value is your minimum premium, and you might have to pay more, but you won't be getting anything back if you're the assured. So the project values, which we'll go into in a minute, can be many, many sheets of breakdowns of values, and the underwriters don't need all that information. We have to summarise that into the major components to enable the underwriters to assess the risk. So it's very important that all elements are included within the contract description. What it doesn't cover is the contractors' vessels and equipment, because they'll be covered under another policy. The contractors will take out their own hull and machinery PD policy. In-hull equipment is not covered under a construction policy. You can get limited cover under a control of well policy, which we'll talk about tomorrow. And temporary works, because the temporary works do not form part of the project value of the overall project unless they're specifically agreed, because temporary works are usually only there to assist in the whole overall project. They're not forming part of the final contract works. So again, just a couple of slides there of equipment that's used during the construction phase. There's a pipe layer there. Yep. Jeff's comment there is correct, that if you're going to take anything away from the construction, this is probably the one to to take away, that the policy is wrapping around the contract, and it's very important that the rights of the policy, or the rights of the various contractors and subcontractors, are identified and exercised through the principal. So if a contractor has suffered a loss, he needs to report that through to the principal. The principal will be the one that will report that to the broker for notification to the underwriters. The broker will work with the loss adjuster and the principal and the contractor usually. Sometimes the contractors are very happy just for the principal to handle the claim for them. But it will all be handled through the principal assured. The benefits that are passed via contract, the insurance policy will not give cover wider than the contract allows, and at the same time it's effectively an either or, and from your point of view as underwriters, it's the good thing is it's the coverage is based on the narrower of either the contract that's in place or the policy wording. So if there is a contract that is between a contractor and the principal and it's very, very wide and covers things that's not included under the construction policy, then those extra items would not be covered. What would happen is if there was certain obligations that had been entered into that are outside of a standard contract, it would be up to the risk management to talk to the broker. We would discuss it with the underwriters, and then there would be an AP paid to make sure that the coverage was in place. But ordinarily, there are certain standard contracts that the underwriters are expecting the policy to be based on. If it's outside of that, that would need to be agreed separately. So what risks does a construction policy cover? The obvious ones that we've headed up there is environmental, so storms, earthquakes in certain parts of the world, tsunamis, etc., etc. We're covering accidents, so dropped objects. Some of the equipment can be very, very heavy. If that gets dropped onto the top sides, that can cause extensive damage. Fire and explosion, there's drilling taking place, hydrocarbons are never far away, so fire is always a risk, as is losses as a result of blowout, which the control of well will not be covered under this policy, but the resultant damage may well be. We're talking about offshore construction, so there will be vessels going backwards and forwards to the site. There will also be maritime activity in certain parts of the world. If the construction site is in a shipping lane or close to a shipping lane, so it doesn't matter how many warnings are put out, there are still parts of the world where ships sail far too close to structures, which cause collision damage, sinking, stranding of the platform. And then there can be construction-related incidents that are negligence. So what do we mean by that? There could be defective design that goes back to the design stage, defective materials, workmanship, latent defects are something that's a fault within the project, within the item of equipment that wasn't known at the time. They will all be covered under the construction policy. The defective part itself is not covered unless you buy a defective part buyback, which can be bought in the market, and we talk about that in a moment. And repairs of faulty welds is usually an exclusion within standard construction forms. So the faulty part, the standard coverage includes loss or damage to non-faulty parts that have been damaged as a result of a faulty design or faulty workmanship. So we've put an example there to try and make that slightly easier to understand. If you had a an engine part that's sitting on a shelf, and the shelf collapses because the bracket was faulty. Well, the bracket isn't covered because that's the faulty part, but the resultant damage to the shelf and the engine are both covered. So in this instance, the shelf and the engine are insured and a claim would be paid, but not the bracket. If you buy the faulty part buyback, that would provide cover for the bracket as well. And faulty part usually has a sublimit. Another additional cover or coverage that's available are leak search costs, which can run into many millions. Again, it's usually sublimited. There may be gas bubbling up or oil plumes that are visible on the sea surface. And it can take time and cost a lot of money to find out where they're leaking from. Often, where they manifest themselves on the water isn't necessarily the source of it. And if it's a very small crack in a world, it can take some time to find that leak point. If you can demonstrate, or if the assured is able to demonstrate that there has been loss or damage, then these costs are recoverable. If they just find the leak but there's no physical loss or physical damage, then the costs are not recoverable. Other additional coverages that are available, cancellation costs. We've mentioned a number of times that the project can be, the lead-in and the build-up can be over many, many years, time-critical items, specialist equipment is needed, and so contracts will be put in place many months, sometimes years before it's needed, to make sure that the right equipment is available at the right time. The example we've got here, if there was a barge that sinks and the barge is carrying a module, topside module for a jacket installation, and there's a crane has been hired to lift the module into place, if the barge carrying the module sinks, that transit is part of the overall construction insurance, then now the crane has no purpose because it can't lift the module. The operator of the crane will want his money. There'll be a fixed rate in the contract. Maybe if it's not used, he'll still get perhaps 90%. So the insurance policy will pay that element of the cost that is due to the owner of the crane barge. He'll go off and do some other work, and the replacement part may not be ready for months or sometimes years. And so the policy would pay for the cancellation of the crane barge as a result of the barge sinking and the module going down with it. Another additional coverage is standby expenses. So if repairs are delayed due to, say, heavy weather, most contracts will have a standby rate for the specialist equipment. Again, very much a supply and demand issue. We have seen examples when the oil price was very high and the contractors had the upper hand, the standby rate was the same as the day rate. So if the working rate was $300,000 a day, even if it wasn't doing anything, it will still, the unit would still be charged out at $300,000 a day. Now with the oil price much lower, with the contractors on the back foot slightly, the standby rate will be considerably less. It might be 40, 50, 60% of the day rate, but it will be, and maybe even lower than that, because the contractors need their equipment working. They'll take, in many cases, they'll take whatever contracts they can get hold of at the moment. Expediting expenses. What do we mean by expediting expenses? That's something to speed up the repairs. So if it involves workmen working at weekends and being paid overtime, if it involves some replacement items being air freighted out rather than sea freighted, that's speeding up the repairs. It's an additional cost, and that would be covered under the policy. If as a result of significant loss or damage, fire and explosion is the obvious one. If it was necessary to evacuate personnel, that would also be covered. So we talked about the additional coverages. What are some of the exclusions? There have been occasions where platforms, the jacket has been put in the wrong place. Unless that's been caused by an insured peril, heavy weather for example, if it's just accidentally been put in the wrong place, that's a business risk to the project, so that's not for underwriters' concern. We mentioned earlier the importance of the broker having the full details, and we go on in a minute to talk about the ECV. So if costs have not been included in the project, they will not be included in the event of a loss, and that can have a big impact on claims. Temporary works, again, unless specifically declared. Anything that's consumable that doesn't form part of the permanent works is not covered under a constructional risks policy. The contractor's own equipment, that's not covered because that will be covered under their own policy. Again, sometimes the contractors may try and pass that obligation on to the oil company. If the oil company accepted that, they would need to make sure that the broker was aware of that and that that could be agreed with underwriters by paying an additional premium. Fluctuations in temperature, wear and tear, those type of exclusions that you'd see in many ordinary property forms are standard exclusions from a construction policy. It's not a fortuity. Equipment that's downhole is not covered. It may be covered on a controller well policy if it's from a named peril. Fraudulent claims is a standard exclusion in nearly all policies. And then there's your other standard non-accidental exclusions that you would see in any standard insurance policy. So from a contractual point of view, what doesn't the policy cover? It doesn't cover performance guarantees. That's a project risk. Penalties, it's against the public interest for insurance policies to cover penalties for delays or non-compliance with a regulatory requirement. Paul mentioned in his presentation this morning when projects are being sanctioned and a need for regulatory involvement, the regulators will want to make sure a project is being built safely and that lives are not being put at risk. If that wasn't the case and the penalty was imposed, that would not be covered by the policy. Loss of use, BI financial policy, there are alternative financial policies available, so that would not be covered under a standard construction form. Consequential losses, liquidated damages, again, there are BI, advanced loss of profits policies that are available, but the construction policy is not covering the consequences to the construction policy. Employers' liability, what tends to happen, there will be knock-for-knock agreements within the construction policy. Each party will generally be responsible for their own employees, and they will be covered under their own employees' liability policy, regardless of fault. Controller well is a separate policy, and the loss of hull would be under the controller well insurance. If there is a loss, how will you as underwriters be expected to reimburse the assured? Basically new for old for items that are repaired or replaced. And new for old includes the towage and installation costs. The demob costs and the towage can be far more costly than the actual parts themselves. Anything that's not repaired or replaced, so if it's an item that's a total loss or a constructive total loss, it will be the actual cost of the item up to the time of the loss. Insurance, as always, and as I'm sure you're aware from your own lines of insurance, the construction form is still about indemnity. The idea is to put the assured back in the position they were at immediately prior to the occurrence. So if there has been a total loss of a part but not the whole project, it will be paying for the part, not for the whole project. Unrepaired damage claims, if there's been changes in technology or if there's a change to the project and something has been damaged but doesn't need to be repaired, the basis of valuation would basically be